Hi, and welcome to the Active Trader Strategy Overview. This is part one, Tools, Techniques, and Concepts. This is a four-part series, 4 videos, each one covering some element that is essential for your success in active trading, whether it's day trading or swing trading. Now, this first video, part one, is all about the skills that you need to apply the strategies. So in part 2, we'll look at swing trading strategies. And in part 3, day trading strategies. Part 4 will be how to use Active Live to put those strategies to work. But this is your toolbox. This part 1 video is all about the skills you need to apply the strategies. Now, it's not meant to replace the content in the Education Center, but rather give you the Coles notes, the overview of everything, but also some of the details that are scattered throughout little videos that I've used to emphasize different points along the way. And so this is a great way, if you've already gone through the Education Center content, a great way to really make sure you understand everything and put all of the important things into one source. All right, so let's talk first about stock charting basics. What are candlestick charts, inflection points, and time frames? If we look at a chart, you can see that there are red and green bars on this screen, and those are what we call candlesticks. So there's different styles of charting. Candlestick charts are the ones I prefer. And so where we have a green candle like that, price opened on that 1 minute candle, because this is a 1 minute chart. Price opened there and closed at the top of the green bar. If the candle's red, it simply means that price closed below the open. So there we've got a red bar, it opened there and closed there. Now these are real basic things. We're obviously going to get into more sophisticated things in a moment, but you can look at charts on many different time frames. This is a 1 minute chart, and then we have a 13-minute chart and a daily chart. But again, if it's green, it opened at the bottom of the box and it closed at the top. And if there's a little tail above the body of the candle, that simply reflects the high of that candle. So this was the high, this was the open, this was the low, and this was the close. Generally, when a stock is trending lower, you'll see more red candles because the stock will move down through the day because the stock has negative downward momentum. When the stock is moving up, we tend to see more green candles because generally price is closing above the open as it moves higher. Now, the next important concept is inflection points. Inflection points are the building blocks of the stock chart. Anywhere that we have a little price peak, we have an inflection point high. And anywhere we have a little floor, we have an inflection point low. Now you can see that these inflection points are plotted on the chart with little plus signs. The logic for what makes an inflection point is pretty simple. For an inflection point high, if there are at least 4 candles to the left and at least 3 candles to the right that are lower than this high, then you have an inflection point high. And for an inflection point low, similar logic, if there are 4 candles to the left and 3 candles to the right that are higher than the low point, then you have an inflection point low. Now these inflection points are important because we're going to use them to define patterns, and really all of the chart pattern stuff starts with inflection points. So it's really important that you understand inflection points, and to keep it simple, just look for peaks and valleys. If there's a peak, you've got an inflection point high. If there's a valley, you've got an inflection point low. So peaks and valleys. Now you can see along the way there's some more minor ones. Those are less important than these ones. And what makes these more important is that there are more candles to the left and more candles to the right that are beyond either the floor or the peak. So this inflection point is much less important than this one, because this has more candles to the left and to the right, making this a more profound price peak. Now let's talk about time frames quickly before we move on to some of the important indicators that we can add to our charts. So this is a 1 minute chart. That means each one of these candles represents 1 minute of trading. These are important when we're day trading liquid, actively traded stocks that are traded very actively. We can look at them on a 1 minute chart because you can see that through the course of a day, it can make some profound moves. And as we get into the day trading strategies, we're going to focus on the 1 minute chart primarily. One strategy, we look at the 2 minute chart. And those things will be covered in video 3, part 3 of this series. Now for swing trading, we tend to focus on the 13 minute chart. And in this instance, the candles represent 13 minutes of trading. So this candle here is on December 20th. It's the 943 candle. And we call it the 943 candle because the market opens at 9:30. This is a 13-minute chart, which means that that candle closes at 9:43. And the second candle of the day closes at 9:56. And the next candle closes at 10:09 and then 10:22. So generally, we attach the time to the candle based on the closing time of that candle. So obviously a 1 minute chart would have a 9:31, a 9:32 candle, a 9:33. But a 13-minute chart has a 9:43, a 9:56 candle, a 10:09, a 10:22, 10:35. If you're looking at a 5-minute chart, you're going to have a 9:35, a 9:40, a 9:45 candle. And then finally, we have daily charts, which is what we'll use for active trading. You could also have a weekly chart. You could have a 8-minute chart. You can have a 2-minute chart. You have candles on any time frame. Some people look at 10-second candles. You'd have to have a really actively traded stock to do something that quick, but there's no limit. You can have a monthly chart, weekly chart. But generally when we're actively trading, we don't use more than the 1 minute, 2 minute, 13-minute, or daily. Now for swing trading, the primary chart is the 13. The secondary chart that we look at is the daily. When we're day trading, the primary chart, depending on the strategy, is either the 1 or 2 minute chart. And then the secondary chart might be the 13 and daily charts. We'll get into those when we do those strategies in videos 2 and 3, part 2 and 3. Okay, so that's kind of the basic stuff. Now let's talk about my indicators for trading. My approach really revolves around abnormal activity. You know, a stock normally kind of trades quietly around $1.25, and then one day it jumps to $1.20, and it trades much more volume than you would normally expect. Then that stock is trading abnormally. And there's usually a good reason for the stock to trade abnormally. It's usually because some people have some information that justifies that abnormal action, causes the stock to jump. And it's a clue that something's going on with that company. So we love stocks that trade abnormally. So what I did is I created some indicators to help us with that. And we're going to look at two primarily. One is the message candle indicator, and one is the action candle indicator. Now, when we look at these charts, I have set the message candle to be the pink dot. So anywhere you see a pink dot, that is a message candle. And I've also put some yellow dots on this chart. That is the action candle. A message candle, very simply, means that the price change was abnormal. And typically it would be a tall candle on the chart relative to those before it. So this candle is a lot taller than the ones before it. This candle is a lot taller than the ones before it. What that means is that price made a big change from that for that interval. This again is a daily chart. And so on this day in December, the stock opened the day around $1, closed the day around $1.75 or so. So it made a big jump that day. That was an abnormal price gain. Now down here you can see there's this indicator called the Stockscores price test that measures the statistical significance of the price change. And you can see on this bar right here, that little red line jumps above the blue. What that means is that the price gain was abnormal. And so anywhere you see a pink dot, you will also see that price test go above the blue line, because that just means it's abnormal. So here is a pink dot, and there you can see the red line jumping above the blue. So to be frank, the Stockscores price test line down here at the bottom is a little bit redundant because it's captured in the pink dots on the chart. All right, now let's talk about the yellow dots. Those are the action candle. Action candles have abnormal price change, but they also have abnormal volume. The volume traded is more than normal. So here you can see a yellow dot and here a yellow dot. We can see that the price jump was abnormal, but we also have a similar indication for volume in the Stockscores volume test. So not only did this stock go up a lot, but it did so with more volume than normal. Here it jumps, the volume is abnormal. That's why it is not just a pink dot, but also a yellow dot. So all action candles are message candles because action candles and message candles have in common that there is abnormal price change. But not all message candles are action candles, because for a message candle to also be an action candle, it must have abnormal volume. Here you can see just a pink dot. And if I look down, I see that my volume test doesn't jump above the significance line, and thus it is not an action candle, it is just a message candle. Okay, so just to recap then, message candles have an abnormal price change, and action candles have an abnormal price change with abnormal volume. And really it tells us, and this is the essential part, it tells us that the stock is in play, that something has investors excited. And it's often the case that after the initial show of excitement, there's more excitement. Now here that didn't happen, but here it did. Some excitement, and the stock went up as more people learned about what made that story exciting. The stock went up. Okay, and we can see message candles and action candles on any time frame that we plot them on. Now these indicators, action candles and message candles, are something that I've had programmed. It's not something you will see in any other stock charting program because it's my own concoction, my own invention. And so I've had these things coded for TradeStation. And as an active trader student of mine, if you are inclined to subscribe to TradeStation, then I will send you my indicators and you can plot them on your TradeStation charts. But they don't come with TradeStation because they're my own thing. So you only get them when you are one of my students. Now, if you opt not to use TradeStation, let's say you're only going to use your broker's charting platform, or maybe you're going to use another third-party platform like TradingView or TC2000 or something like that, you're not going to be able to plot the action candles and the message candles. Now, you can still see them. It doesn't take a rocket scientist to see that this price jump is abnormal and this volume is more than normal. But it is nice to be able to actually have the computer put the little dot there so you know that that is an action candle or a message candle. For many of my students, they maybe won't start out using TradeStation because it comes with a cost. It's $99 a month US. And when they're learning and developing their skill, they want to keep costs down, so they don't necessarily subscribe to TradeStation. But eventually, it really is worth having TradeStation because it's such a good program. You will make more money in the market by having it because it's going to give you some tools to find these opportunities early. Now, if you're on Active Live, we're going to highlight the stocks that are making the action candles or the message candles. And unless you have TradeStation, you won't be able to see them on the chart, but you'll see on the Active Live screen that they've been highlighted. And more about that in part 4 of this video series on Active Live. Okay, so let's now take a look at a 1-minute chart. Again, here you can see message candles and action candles. Action candle, abnormal price with abnormal volume. Message candle, just abnormal volume, or abnormal price rather, but no abnormal volume. All right, let's talk about gaps and volume itself. So let's go to the daily chart now. So a price gap occurs when the opening price one day is higher than the closing price the previous day. And it happens because when the market opens, there's a lot of excited buyers lined up to buy, and they are willing to pay more than the closing price the previous day. Now that happens when the company has something exciting. It could be some news, it could be simply a rumor in the market. But, before the market opens, there's this balancing that is done by exchanges, the New York Stock Exchange, the NASDAQ stock market. They have computer systems that take in all of the buy orders and all of the sell orders, and they try to match them. And that there's a process that goes on before the market opens to determine the opening price based on the demand for the stock, the buyers lined up to buy, and the supply of stock, the people lined up to sell. So if there's strong demand and weak supply, then often the stock will gap up in price. So it's another show of abnormal activity. Now, the bigger the gap, the more likely that the stock is going to pull back after the open. And so we're always cautious about stocks that make large price gaps on the open because they often then go the other direction at the start of the day. And so my rule is that if the price gap is bigger than the tallest day in the last 2 months, so this is a tall day right here, this is a tall day, if that gap is bigger than the tallest day, then you want to be cautious about entry signals early in the day. And it's simply because the natural tendency is for these stocks to pull back when they make big price gaps. Now, this is not that big of a price gap because it's not taller than even the previous day or, the day a couple of weeks prior. So that gap was not that significant. But that's how we measure the size of gaps relative to the recent past. Now, why do stocks pull back after they gap? Well, imagine you were a buyer of this stock at $1.90 on that day, and the next morning it opens at $2.20, there's some incentive there for you to sell the stock because you've realized a very quick profit overnight. And so the bigger the gap, the more the price change at the open, the more likely it is that people will sell into that strength. So we need a way to determine what is a big gap, and I find a simple way is just to look at what is a big day for the stock. If this price gap is not bigger than these kind of days, then we can see that the stock has the capability to make those kind of big price moves. And so the buyers can push it up and the sellers aren't that eager to sell until the price gain gets to be too much. Because again, the incentive for a trader is to take profits when there's a big price gap. And then volume is very simply how much of the stock is traded, but we can measure that in different ways. We can measure it simply by the number of times the stock trades. So the number of shares that are traded. So a stock could trade 1 million shares in a day. The problem with measuring volume by looking at the number of shares traded is that it's very different based on different prices of the stock. So if the stock, is a $20 stock and the stock goes up, if the stock that's $20 trades 1 million shares, then it's very different than a $1 stock trading 1 million shares. We don't want to say that that's the same volume because a stock trading 1 million shares at $20 is $20 million worth of stock. A stock trading 1 million shares at $2 is $2 million worth of stock. So for that reason, I like to measure volume by the number of trades. How many times it trades. And in TradeStation, there is an indicator available in TradeStation called Volume Custom, where you can plot it by number of trades. So again, this is a 1-minute chart, and this bar right here had 138 trades. So on that 1-minute interval, that stock traded 138 times. Whereas on this bar, it traded much more, probably 450 times on that bar, maybe 400. Okay, and we can plot that on different time frames. So here it is on the 13-minute chart. I can see that on this volume bar right here, it traded about 5,000 times. So it was very actively traded. So we refer to that as liquidity. How actively traded the stock is depends on the number of trades. So when we're day trading, we tend to only want to trade stocks that trade at least 10,000 times a day. And preferably, if we're going to go off the 1-minute chart, 20,000 times a day. So we're always looking at the number of trades as a clue of how liquid the stock is. And the way I want you to think about this is as follows. Think of the market as this crowd of people. And there's all these stocks that they can trade. In North America, there's probably 15,000 stocks. Well, that crowd kind of moves around from stock to stock, depending on what's exciting. And the bigger the crowd that is trading the stock, the better, because that means that investors are more emotional, there's more demand for the stock, and so it can make much bigger moves. And so what we find is that stocks that make the biggest moves, percentage-wise, a stock that goes from $1 to $2 or $5 to $8, does so because there's very abnormal volume and because there's very good liquidity. So those are two words that kind of reference the same thing, but they're actually a little bit different. Liquidity is how actively traded the stock is, Is it trading 10,000 times a day, 100,000 times a day, or 1,000 times a day? 100,000 times a day is very liquid. 10,000 times a day is pretty liquid. 1,000 times a day is not that actively traded. And then we can think about volume in terms of the abnormality. When you have abnormal volume that's bigger than what you would normally see, then you have a crowd that is gathering around that stock. And it's usually because something is happening. Something has captured the interest of the buyers and makes people want to chase after that stock. Those are the kinds of stocks we love. If you're day trading or swing trading, the best candidates have high liquidity, actively traded, and abnormal volume. They have a crowd, and the crowd is big. Those are the best ones. Now, hot stocks will start off being very quiet, like this stock was very quiet, and then it starts to behave abnormally, starts to get more volume, and as it goes up higher and higher, the volume gets bigger and bigger because the crowd is getting bigger and chasing the stock higher. So volume is so important to be watchful of because we're trying to trade those stocks that are in play, that have the interest of the buyers and sellers, and they're characterized typically by abnormal volume and strong liquidity. And we call these stocks alpha stocks. Now, the next thing we'll talk about is trend. So trend is simply a measure of whether the stock is going up or down. If the buyers are in control, the stock's in an upward trend. And the simple way to see that is if the bottoms are rising, if the inflection points are generally going up from right to left, then you have an uptrend. Sometimes price runs away from the trend, and then it comes back to the trend. Runs away from the trend, comes back to the trend. Runs away, comes back. So we never want to be a buyer when price is running away from the trend because usually price will come back to the trend line. Now we can have a upward trend and we can have a more minor downward trend. Here's a minor downward move. Generally, uptrends are formed by an upward move and a pullback, an upward move and a pullback, an upward move and a pullback, and then you draw a line across the pullbacks, and that defines your upward trend. Now we can have downward trends as well. Just take a line, start it at the high, and let it fall until it hits a few different points. So I could have a trend line like that. I could have one like that. This means that the sellers are in control because the stock is in a downward trend. And that means investors are pessimistic. And so generally, we don't want to buy stocks that are in downward trends because they have downward momentum. It's like trying to paddle a canoe up the river, up current. Doesn't work very well. It's better to trade with the trend. So if the trend is up, then we want to be thinking about buying. But there's a caveat to that. This is very important and often overlooked. We do not want to buy stocks when they've run away from their trend line. We don't want to buy the top of flagpoles. We want to buy when they come back to the trend line and then start to go up again, or when they break from a sideways pattern. So here we have a sideways pattern and they break out from that, but they do so from rising bottoms, which is optimism. They're sideways and they break. And they move up, they pull back, and they break their pullback. They move up, they pull back, and they break their pullback. These are the times to buy, but not when they run away from the trend line. It's a very simple concept, but if you are a normal human being, you're going to do the opposite. You're going to be most interested in buying when the stock is up here because you're watching the stock go up and up and up, and you're saying to yourself, I should have bought at $2. Now it's at $2.50, and you get wrapped up in the emotion of the price trend, and that stock can often run away. You get emotional, you chase it right before it comes crashing back down again. So do not chase stocks that run away from their trend line. It's okay to buy breakouts through resistance. It's okay to buy stocks that pull back to the trend line, but do not buy them when they run away from their trend line. Okay, let's move on now to putting all of these inflection points and different concepts together to measure charts. Now, we've already kind of talked about optimism and pessimism, but let's just go over it again. So if there's falling tops, that's pessimism. If there's rising bottoms, that's optimism. Using my metaphor of canoeing on a river, when you have pessimism, you don't want to be a buyer because you're trying to paddle upstream. When there's optimism, then you can be a buyer because you have the current in your favor. The wind in your sails, the current in your favor, whatever metaphor you like to use. But it's all about trading with the direction of the market, with the mood of investors. Don't buy when there's pessimism, only be a buyer when there's optimism. Now, pessimism can turn to optimism when the trend line is broken, and even better when price breaks up from a rising bottom. So there's our first rising bottom, and now we have optimism where before we only had falling tops. So we only had pessimism. We can look at that on any time frame. Here is optimism. Over here there was pessimism. A little bit of pessimism broken, build of a rising bottom, break up from a rising bottom, meaning breaking up from optimism through resistance, stock goes up. So now let's talk about support and resistance. Resistance is a price ceiling at past inflection point highs. Support is a price floor at past inflection point lows. So if we want to start by drawing out support, we can just say where are their inflection point lows, and we call that support on the chart. And resistance can be found at inflection point highs, like that. But we can also call this resistance if there is a downward trend that is broken, because that's also resistance. So sometimes resistance can be horizontal, and sometimes resistance can be a little downward trend inside a longer term upward trend. All right, that's support and resistance. Now let's talk about price volatility. How much price is changing is a measure of volatility. So when a stock is going up quickly or going down, that means that the stock is volatile. When the stock is going sideways, that means the stock is not volatile. Now, the easiest way to see low volatility is when there are rising bottoms converging towards the falling tops. So if the line that you draw across the tops is moving toward the line that you draw across the bottoms, then you have low volatility. When the line that you draw across the tops is diverging from the other one, then you have high volatility. Now, why does that matter? Well, we love it when stocks break through resistance from low volatility with abnormal activity. You've got an abnormal candle there, an action candle. You've got a line of resistance. You've got optimism. And you've got those two lines converging, so you've got low volatility. That's a beautiful thing. Here you've got a line drawn across the tops and a line drawn across the bottoms, so you've gone from volatile to low volatility right here. Here it's high volatility. There it's low volatility. And then when you break from that, the stock often continues higher. So no matter how much the stock has gone up, because if we look at this stock on the daily time frame, you can see that it's gone up a lot. It started at 50 cents down here, and 2 or 3 weeks later it's at $3. It's gone up a lot. So it's a lot of volatility on the daily time frame. However, along the way, it builds little floors. It goes up and then it builds a floor. And then it goes up and it builds a little floor. There's rising bottoms, falling tops, they're converging. So this is a break from low volatility. This is a break from low volatility. And we also pulled back to the upward trend line right here. So now you're starting to get a sense of patterns. So let me draw you a picture to show you how stocks typically move. This picture is worth 10,000 words. All right. So typically a stock will be boring. It'll be just kind of meandering along without a lot of excitement. Volume will be low. Then you'll see the stock break out and volume will pick up. So this is your first stage of action. You're breaking from low volatility with abnormal activity. Now, because this is the first break, the stock does not yet have good upward momentum. It's just getting started. And so the probability of success of buying this first break is lower than if you wait for the stock to have some upward momentum. However, although the probability of it being a stock that's going to go up in the near term is lower, the probability is lower, the potential profit is higher because you're getting in earlier. You know, if you buy up here, you're also buying a break from low volatility. So the probability is higher here because it's got more upward momentum than it does here. The probability is lower here, but because you're buying at a lower price, your upside is more on the first break. And so it's a balancing act. If you buy the first break, maybe you're only going to be right half the time. But when you're right, you might make, 5 times what you risk. Whereas if you buy a little later, now the success rate might be more like 70%, but the potential profit, if it was, say, $5 a share here, now it might only be $3 a share. So if you've got a 50% chance of making $5 or a 70% chance of making $3, what's better? Well, we can calculate what's better by multiplying these two. If we have a 50% chance of making $5, that means your expected value is $2.50. If you've got a 70% chance of making $3, then your expected value is $2.10. So in this example, and I'm just arbitrarily picking these numbers, they don't have any meaning. But in this example, if you knew that that was the probability, then you would say that this is the better trade than this one. But if this success rate was only 40% and this one was 80%, well, now that changes the numbers quite a bit. This becomes 240 and this becomes 2. And so in this instance, the second entry can be better. Generally speaking, the first break is going to have a probability around 65%, as long as there's no pessimism. If this is sideways and not downward trend, then that's kind of 60% success. Whereas when you buy this little higher one, it's about maybe 70%. But the upside here is greater than here. And I'm willing to buy both. Both are profitable to buy in the right instances. But some people like to be right. And so they don't like buying those first breaks because they don't like being wrong some of the time. And you're always going to be wrong some of the time, but how often you're wrong depends on the momentum of the stock. All right, let's go back to drawing some patterns. So we've got a stock that's quiet and it comes alive, and then often it'll make a little pullback, and then it'll start to move up. And then it'll pull back again. All right, so it's established entry point number one. You do not want to be a buyer up here because it's gone up too much from where it first gave its entry signal. Now you're waiting for the stock to break a pullback. So this would be entry point number two. Now that stock has defined its upward trend line. Okay, now when we get back up to here, this level here is probably going to be resistance. So we tend to see the stock do this. And then it might break again. That would be entry point number three. Different patterns. So you've got the initial break here, you've got the pullback break here, and then you've got a momentum break up here. Now the way trends work, typically, is a stock will go up, it'll pull back and break the pullback. When that happens, this is not important resistance. It will often then go up again, pull back and break. This is not going to be resistance. It'll go up, it'll pull back, but this time if it pulls back, if it breaks the upward trend line, once it breaks the upward trend line, then this becomes resistance. And so then if it breaks the pullback there, right there, we would expect that it's going to come up to this resistance level and get stuck before it can ultimately break higher again. So we always want to think about where resistance is, because we want to make sure that our trade has double the upside for the downside. So if we're buying here and our entry price is there and our stop loss is here, we want there to be 2 times that distance up to the next level of resistance. All right, so let's put some of these concepts to work in a chart. So here you've got a stock that makes a run up, and then it makes a pullback, and it breaks the pullback there, but we are below that level of resistance. So we don't have the 2RR up to resistance. And that's okay, because we pause at resistance and then make a breakout there with a action candle. So that tells us that that stock is now ready to make the next leg up. It goes up, it pulls back. It goes up, and now it is what we call overbought. You do not want to be a buyer when that happens. Now, if you're a normal human being, you're going to feel most excited about the stock up here because it's been going up for quite some time and it gets you really excited. You think, well, it was at $2, now it's at $2.70, and somehow that makes us think that it can go to $4 because we get caught up in what has happened recently. But as traders, we have to think about not what's happened recently, but what is going to happen next. Weakness into a trend line means that it's likely to go up soon. But when you see weakness, if you're a normal human, you're going to be worried. When the stock goes up, now we've got this confirmation from the market that the stock is good, and so we are most excited when the stock is running away from its trend line but when it runs away from its trend line, it's likely to pull back to the trend line. So we know that a stock is overbought when the distance down to the trend line gets quite far. So to draw a trend line, we start at the low point, and we're just going to let our line come up until it hits some inflection points, and that defines our trend line. So I used the low here and this inflection point, and then it basically touched it there again. Overbought here, comes back to it. Overbought here, comes back to it. Now we can look at this overbought, oversold on multiple time frames. A stock can be very fairly valued because it's at the trend line on the 13-minute chart, but it could look very different on the daily chart. And so you always want to trade the time frame or analyze the time frame that you're trading off of. If I'm a swing trader, I'm looking at the 13-minute, but the daily chart could give me a very different impression. If I look at ANY on the daily chart and I draw my trend line, I'm going to say that here, 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 I am overbought because I'm way above the trend line. So if I was trading off of the daily chart, I would not want to be a buyer. However, let's now take a look at these 4 or 5 days on the 13-minute chart. And that's these days right here. So on the daily chart, it looks like it's always overbought. But when you draw the trend line on the 13, you can say, well, it wasn't overbought there. It wasn't overbought there. Okay, so this is December 19th. This is December 21st, around the middle of the day. If I go back to that daily chart, December 19th was, I think right here, and December 21st, or I can't remember the dates now, was way up here, wasn't overbought on the 13-minute chart, but on the daily chart, it was very overbought. Right? Now on the daily chart, it's coming into resistance. So it's overbought and coming into resistance. So the daily chart says it's going to stop going up because it's rallying up into resistance and it's overbought. If I go to the 13-minute chart, I can see that here in that point of the day, it was overbought, but at the start of the day, it was not. So on the daily chart, we expected it to pull back. On the 13-minute chart, buying up here was a fool's game because it was overbought, and look what happened. It started to pull back. And then we could look at what happened on the 1-minute chart. On the 1-minute chart, you had the upward trend there. You ran away, overbought, pulled back, worth buying. Ran away, overbought, pulled back, worth buying. Overbought, pulled back. Now it broke the upward trend line. Now this becomes resistance. And then the stock, once the upward trend line was broken, didn't really go anywhere. So these are simple concepts that get hard to keep track of when you're looking across multiple time frames. You know, trend lines, inflection points, optimism, pessimism, price volatility. You have to understand those things really, really well and see them on multiple time frames, the daily chart, the 13-minute chart, the 1-minute chart, and try to see how those things all come together. The daily chart, the 13-minute chart, and the 1-minute chart, we're all saying do not buy here because A, on the 1-minute chart, it was overbought. On the 13-minute chart, it was overbought. And on the daily chart, it was overbought and it was at resistance. That was way up there, 324. So there was a good reason to expect that that stock was going to pull back there. So the shape of the pattern is important. And the shape comes down to drawing trend lines, where price is relative to the trend, and understanding who's in control. Are there rising bottoms or falling tops, optimism or pessimism? Where is resistance? And understanding what defines resistance when the trend is up, when the trend has been broken. If the trend gets too steep, let's say you're going up and it gets really steep, then you know that there's a much higher chance that the stock is going to pull back because it's overbought and the buyers are chasing it emotionally. So we always like stocks, if they go up quickly, we like them to take a little pause and build a foundation and then break. Don't buy here, but actually be willing to buy there. Even though this price is higher than this price, this is a better buy point because the stock built a foundation here before it moves up again. Don't be a buyer up here. Wait for it to pull back and break the pullback, or wait for it to build a new foundation and then break. We either want to buy breaks from sideways trading or buy pullbacks, preferably to the trend line. Buy it there before it moves to the next move up. Pullback, break, buy it there. Do not buy it at those peaks. Now, we talked earlier about liquidity. The more liquid a stock is, the better. What is liquidity? How actively is the stock traded? What is the number of trades? The more trades there are, the better. And we can measure liquidity just by looking at trade volume, but it's better to look at number of trades. And so on Stockscores, on the website, stockscores.com, we show you what the liquidity is. The number of trades is disclosed there on the website. If you have TradeStation, use that volume custom indicator that I showed at the top of the video. Another good reason to use a program like TradeStation because it shows you number of trades. Most charting programs only show volume, the number of shares traded. And I know it sounds like I'm a marketing person for TradeStation. I get nothing from them. I have no link to them. It's just the best platform that I've found because it does all these things. But it has a cost, $99 US a month. But will you make that back? If you're trading and you're following the rules, yeah, you should make that $99 back very easily. A lot of people get caught up on the cost and not the benefit. The benefit far outweighs the cost if you're actually trading. If you're learning, I wouldn't rush to get TradeStation. Wait until you're ready to start trading. All right, a few more terms that we're going to talk about before we end this video. Now, float is the number of shares available to the public to trade. How many shares are available for trading? That's called the float. So a company could have 10 million shares outstanding, right? 10 million shares outstanding, but if only 2 million shares are in the float, then that's what the public can trade, the 2 million shares. Now imagine a stock that trades 100 million shares a day with a float of 2 million shares. That means that float is being turned over 50 times in one day. So we like low float stocks that are actively traded because there's not a lot of shares available to trade, but there's a big crowd wanting to trade them. And so the stock can make these really massive moves. So one of the things that we look at with our strategies is the float. And it doesn't mean that we won't trade stocks with much bigger floats, but a stock that has a float of less than 20 million shares just tends to make bigger moves, potentially anyways, provided it has liquidity. Now, alpha versus beta. Alpha is how much the stock is trading on its own story. That's the alpha. So alpha would be, a stock is going along normally and then it starts trading really abnormally, really strong volume, making big price gains. That is a stock that's now trading on its own story. Most stocks are beta stocks. They move with the market. So I often use the metaphor of boats on a lake. On a lake, there's wind, and the sailboats all move with the wind. The sailboats are the beta stocks. And then there's a few motorboats out there that even if the wind is against them, they can still move up. because they have something about their own story that is powerful. Those are the alpha stocks. We mostly trade alpha stocks. We are always looking for alpha. Those are the stocks that can move 100% in a day or more. How do you find alpha? Look for abnormal volume, abnormal price change. Now, the last thing I want to talk about is market factor, because when we're actively trading, the general direction of the market has an influence. That's the beta factor. That's the wind on the lake. Now, if you have a motorboat, if you have an alpha stock, but you also have a market that's moving up, so you've got wind behind the motorboat, it can go even up even more, right? On the other hand, if you've got a little bit of wind against you, but you've got a strong motorboat, let's say the market's a little bit negative, but you've got a really abnormal stock, it can still go up. But some days the market is so weak that it really takes most stocks lower. It doesn't happen very often. A few times a year, you've got a really strong down day. So the beta factor, the wind in the sails of our sailboats, the beta factor is very strong. And in those days, you really want to shy away from being a buyer of stocks. So we always like to look at market factor. What is the market doing? And I like to look at the Russell 2000. The symbol on that is IWM. It's an ETF or an index of the 2,000 small cap companies in the US. So it's called the Russell 2000. And the symbol we monitor is IWM, India Whiskey Mike. And we look for the general trend. We look for how the stock or how the market is trading around its opening price, whether it's up or down, and whether it's overbought or oversold. So those same concepts that we talked about can be applied to the IWM chart. Here the trend is down, so the trend is against us. This is pessimism. Here the trend is up, so we have optimism. It's going to be easier to make money when the trend is up than when the trend is down. When the trend is down, you need much more alpha. You have to only trade alpha stocks. Whereas when the trend is up, most stocks will go up with the trend. Now then we want to think about whether the stock is moving up or down from the open. So if the market opens here this day and it's moving up through the day, it's going to be a lot easier to be a day trader because the market is being pulled higher through the day. On the other hand, if the stock market is moving down through the day, it's going to take most stocks down with it. Only the alpha stocks can move up. Now we can look at that on an intraday basis. I like to look at a 5-minute chart. So here is the opening price. And you can see that for the first part of the day, the stock market moved down. And then at the end of the day, it moved up. So it's going to be easier to be a buyer when this is happening than when this is happening. Here the market was moving up, and then it fell apart at the end of the day. And so at this point, when it started to break through support from pessimism and moving lower, your day trades are going to have a hard time, and your swing trades are going to have a hard time doing well because the market's moving against them. So we always want to keep an eye on the market. It matters more, the market matters more, when the trend is down, when the market's below the open. On those days, you want to be fussier about what you buy. And by fussier, I mean more emphasis on alpha. And by alpha, I mean more abnormal volume and stronger liquidity. That's the rocket fuel that can disconnect the stock from gravity. Even though gravity is pulling it down because the market's moving down, if you've got a rocket ship of a stock because it's got abnormal volume and strong liquidity, it can move up despite what the market's doing. All right, so that is part 1, how to read charts, essentially. Part 2 will be about swing trading. Part 3 will be about day trading. And we're going to take these skills and apply them to the strategies for swing trading and day trading. But you have to understand this stuff first. So don't be afraid to watch this video 10 times. There's a lot of information in it. Go back to it anytime you're feeling a little lost. Come back to the basics. If you can understand everything in this video really, really well, you'll be able to read any chart in seconds. But it takes practice. The more you can practice reading charts, the better you're going to get at it. It's like any other skill. I'll see you in part 2.